Hey, folks, welcome to Market Intraday Analysis by InTheMoneyStocks.com, your leaders in pure technical analysis, avoiding all that Wall Street hype. Today, Thursday, April 14th, 2011. Folks, just before we get into this hardcore analysis for the intraday period today, I just want to remind you can take a 7-day free trial to the Research Center and the Intraday Stock Chat. Just go to InTheMoneyStocks.com. You'll see the banners all over the website. Click there, sign up. It's free. Give it a shot. All right, let's get into the hardcore analysis now, guys. Markets initially being weak on the day. There's a couple reasons for the weakness. Number one, jobless claims jumped to 412,000 from about 385,000. That's not good to see. More people filing for unemployment. You have to wonder where this strong economy is, or is it starting to lag already as we come to the end of QE2? In addition, PPI numbers. Core was hot. We saw inflation across the board on the producer price side. That's the PPI producer price index. And again, on the producer side, you're still seeing this inflation. We're going to get CPI numbers coming out here as well in the next day or so. And again, we'll be able to see if that inflation is continuing to creep into the consumer side. Bottom line is, this is the scary thing. And again, you can see the markets reacted early on, though they have floated back up as the dollar has declined. The market has to be worried the Fed has put us in a major pickle here. The key is, and the worst case scenario for the Fed is what's called stagflation. Stagflation is where you have inflation but no growth in the economy. Why is that bad? Well, usually when you have inflation, you have growth in the economy, so as prices go up, people are making more money. However, stagflation means people aren't making more money, the economy's not growing, people are still jobless, and you have inflation, so prices are going up, but people can't afford the price increases. And that's the big fear right now. I think the market's kind of getting a sense of that right now. Is that down the line? Are we going to see that in the next 6 to 12 months or next year to 2 years? My guess is yes. I actually called for this over 2 years ago. I said, ultimately, when the Fed comes in here and saves things, you're going to see this as the long-term repercussion. So again, just be aware that that is something that we'll have to deal with and we have to monitor in the coming weeks, months, years in this market. Now, again, markets did gap lower. One of the main reasons, not only was it because the economic data was a little scary, but also because oil was weak this morning. Oil was on the weaker side. Now, usually the average investor, kind of the not-so-smart investor, just because they don't know enough about the markets, would say, well, weak oil is good, right? It's cheaper for the consumer. They can go fill their car up for cheaper. Well, that's right for the overall economy, but when the indexes are made up of primarily of energy stocks or are overweighted in energy stocks like the S&P 500 is and the Dow Jones Industrial Average, well, then a drop in oil actually is negative for the indexes and the market. And so this morning we saw Chevron and Exxon opening lower, and I can bring up the chart of Chevron here. You can see exactly what I'm talking about. So Chevron gaps down here on a little bit of a downward move down about 50 cents or so early on. Markets are weak because of that, because Chevron and Exxon are two huge components of the Dow Jones Industrial Average. So the gap down there actually brings the indexes in and gaps them down, and then what happens is oil starts to rip higher. And as oil rips higher, take a look at the USO. This is the USO chart, which is, again, the United States Oil Fund, the ETF for oil. Look at this. It starts out weak, down a little bit, and then look at the surge up. As oil moves higher, contrary to the average investor's thought process, markets will respond. That's exactly what happens. Oil's gone up here. What have the spiders done? The spiders have gone up as well. So the market responded. Now, why did the market respond to oil going up? Well, because Chevron and Exxon are major components of the indexes, and they went up. And again, there's tons of other stocks that are part of the indexes. I mean, you could just go through the list of the S&P 500 and find, tons of companies. Even in the Dow Jones Industrial Average, there's a ton of companies that are commodity related as well. And as that oil price goes up, as commodities rise, the market should follow suit. In addition, the dollar started to decline, which is one of the main reasons why commodities went up. Why did oil go up? Why is silver soaring today? Why is gold soaring today? Because the dollar is getting punished again. Who's behind this? Well, Federal Reserve, obviously. Whether they're doing it today intraday or they're just continuing to print dollars like they've done for the last couple years, trillions and trillions of them, that's up for debate. But either way, the dollar continues to get punished here. Let's take a look at the UUP, which is the ETF for the dollar. I mean, look at that. Just down it goes. Lows of the day essentially right here, down 9 cents on the UUP, which is the ETF for the dollar, and that's where you have it right now. All right, so just be aware of that, folks. That's the repercussion here. You have the Federal Reserve purposely trying to weaken the dollar. That actually props the markets up by multiple effects, mainly by strengthening commodities. Commodities strengthen, then the stocks that are related to those commodities are going to go up because they'll make more profits, like Chevron, Exxon, and some of these other ones, and then those push the indexes up themselves as they're components of that. I know it seems like a kind of a roundabout, kind of complex thing, but it's really not that complex. It's just a matter of looking at the dollar. What's the dollar doing? Well, the dollar's been heading lower. Markets have been heading higher. Market obviously is inverse to the dollar. All right, let's take a look at silver and gold. What a move here. The SLV is up another dollar today. What a move. SLV soaring, hitting a high of $40.76 today on the SLV. Silver's closing in on $42 per ounce there. And again, you can see what a move up. If we go to the daily chart, look at this vertical move on silver, guys. 26 bucks in late January. Now over basically 41. That's a $15 increase on $26. Think about percentage-wise what that is. Way more than 50% at this point. Way more. GLD is responding as well, up $1.54. What a monster movie on the GLD. Although the GLD is coming back to this little double top, you can see you actually tagged that little bit of a level right here on the GLD, which is gold, the ETF for gold. So that's double top right there. That's something you want to follow to see if that resistance holds up. So far it has on an intraday basis. If we go to your intraday chart right here, take a look at this. All right, you have your little pivot top right here. Just draw your line across. You can see it basically got right up there to that little pivot area right from here on the 8th of, that's the 8th of April. And that pivot top now stalled, gold out, and gold's pulled back a little bit off those highs. Let's go back to the SPY, talk about another fantastic day trading day this morning. I tell you, if we could have day trading like this all year round, it would just be a great thing, as the last week or so, especially this week, has been unbelievable. The market's gapping down. Right away, we recognized the fact that you gapped below these two support levels, the low from here and this little pivot low right here. A little bit of a river theory tells me you should go to your next resistance, or support, I should say, down here, your next level on the downside. So there was a little bit of a shorting opportunity right there. The markets did fall based on the river theory, which is a level or theory created by In the Money Stocks, created by me here at In the Money Stocks. And sure enough, as we came down, we hit the next level at 130.40. Why is that level important? Well, go to your 60-minute chart. Take a look. This level is unbelievably important. In fact, we'll go to the 10-minute. You see it on the 10-minute. Zoom out on the 10-minute here. Look at this little pivot low. You go back to the 28th of March, you have a major pivot low right here at 130.40. So right at that level, I messaged or said it, since it's on a microphone, to the chat room. And by the way, remember, free trial of this chat if you want it, and the Research Center for 1 week. Buy the SPY right here. Buy the market. You can buy the S&P. You can buy the Dow. You can buy whatever you want. Buy the Qs. I don't care. You can buy anything. Buy it. Go long. The markets are going to bounce here. 130.40 was the entry given. Sure enough, look at the markets move up. As the markets moved up, we talked about whether or not we'd short this level right here. I said, actually, don't do it based on what I'm seeing, what I'm reading, and this is why the chat is so important. I know where, and I can read the market, where to short, where to not short, where to go long, where to not go long. It goes right through that level. I say, wait for the 20 moving average and short at the 20. 20 comes up. We nail a short there on the downside. Nice little pullback. Where does it pull back? Right into support right here. Confirmed above, pulls back right into this area. That holds because it's a confirmed level. Then from that point on, the spiders move up. We go to the 50, stall out, consolidate, actually touch a little bit of gap fill right here, and then pull back off gap fill. So the levels, again, you can just dictate it. In fact, not only did you pull back to this area right here, but recognize the in spirit of bull flag. That's a classic in spirit of bull flag, folks. Doesn't take out this level. If it closed below here, below this yellow line, you would have negated it. It did not. It hammered on it a couple times, and sure enough, to the upside it goes. So again, moves back up, hits that gap fill, and now it's stalling out and pulling back a little. Markets are slightly lower, but not by much anymore. Dow is down 15 points, minor loss there. Nasdaq's down a little bit more, but Nasdaq was up more yesterday. Nasdaq's down 14 points, and the S&P 500 is down about 3 points on the day. So minor loss on the S&P and the Dow. Why was the Nasdaq up more yesterday than the Dow and S&P were kind of weaker? Well, the easy answer is because commodities were weaker yesterday. Commodity stocks were weaker. Today, we're seeing commodity stocks like Chevron up over $1. Therefore, in theory, the S&P and Dow should be stronger, right? And it is. And the Nasdaq's lagging today a little bit. So it's just all about understanding that. I mean, understanding what components make up the indexes. That'll tell you exactly why an index may be strong or weak. Generally, over the last few days, we've seen the Nasdaq be stronger. Today, it's a little on the weaker side as money is going back into the commodity place. All right, I think that's about it for today, guys. Again, reminder, come join the free trial at inthemoneystocks.com. Get involved, start making money, start learning our key principles and methodology, and start making, again, the money that you deserve to be making. Take care, guys.